Welcome to the first edition of the Aparti Daily podcast, the show where we keep you up to date on the latest news and trends in the multifamily space. So, this is the first edition of this episode. This is our first time trying this out. And if you don't know, we have a newsletter that we run called the Aparti newsletter. And basically, every single day, we send out newsletter articles, keeping our multifamily operators in the loop on what's going on in the multifamily space. So we decided to bring our newsletter articles to the podcast. So in these Aparti Daily episodes, we're going to go through three of the newsletter articles. We're going to go through the three top newsletter articles from the Aparti newsletter. We're going to review them, and we're going to give you our take on what's going on in the multifamily world. So if you're not a member, if you haven't joined the Aparti newsletter, make sure you head over to apartify.co/news and get on the list. With that being said, let's go ahead and dive into article number 1. Reimagining real estate. Office to residential conversions are on the rise. So basically, Aparti brings you exciting news on, so basically the article reads, Aparti Daily brings you exciting news on the world of adaptive reuse. Today we explore the trends of office to residential conversions with a specific example from Hines, a leading real estate developer. Breathing new life into old opportunities. The demand for multifamily housing, coupled with a surplus of vacant office space in some areas, is driving a surge in office to residential conversions. This trend offers a sustainable solution for revitalizing outdated buildings while meeting the growing needs for housing. Hines takes the plunge. So Hines, a prominent real estate firm, is spearheading the movement with the conversion of the South Temple Tower in Salt Lake City. This is a 25-story office building which will be transformed into a 217-unit apartment complex. All right, so basically what makes this deal attractive? So there are several factors that makes this deal attractive. It says the rise to office space conversions, location, sturdier construction, and environmental benefits. And then we go into, is this conversion right for you? This approach might not be suitable for every investor. Here are some key considerations: market demand, building sustainability, financial feasibility. All right, so what do we have here? Office to residential conversions. So I think we're going to start seeing a lot more people dive into the office to residential conversion game. And this is going to be twofold. So we're going to see a lot of people dive into this space thinking, hey, there's a lot of these vacant office buildings downtown. Everybody is working from home. So it only makes sense to convert these vacant office buildings into multifamily dwellings, basically. And I think a lot of people are going to think it's a gold rush. But what they're going to run into is they're going to see that offices are built totally different from multifamily real estate. They're also going to run into a hiccups of probably the cost is going to be higher than they expected. They're going to run into the building layouts or the floor plans aren't able to accommodate what they're trying to do. So I think these conversions, a lot of people are going to go towards doing the conversions, but they're going to run into a lot of headaches, and they're going to start saying the costs outweigh the benefits. And then everybody's going to put a pause on their office to residential conversions. And then we're going to be back at square one, which is what do we do with the office space? And ultimately, people are just going to have to return to the office space. It's going to look different, but you're just going to return to the office. That's what's going to happen. Now, I could be totally wrong, but I think people are going to return to office. This office to residential conversions is going to get quite pricey for what they're trying to do. They're going to go ahead and pump the brakes on it and try to figure something else out. So that's my prediction. Am I right? Will I be right? Will I be wrong? We'll see. We'll let it all play out. So that's article number 1. Let me know in the comments what you guys think. Let me know in the chat what you guys think. Also, if you want to see any of these articles that we're reading today, go to apartify.co/news. Get on the newsletter. These are delivered straight to your inbox every single day. So you'll get the article, you get to read it, come on the podcast, hear me talk about some commentary on each topic, and then come up with your own spin. So that's that. Let's go over to article number 2. So, article number 2 reads, so this article reads, multifamily starts hit the brakes. Construction slowdown in March. So basically, according to a recent report citing data from the U.S. Census Bureau and the Department of Housing and Urban Development, construction starts for multifamily developments saw a dramatic year-over-year decline in March of 2024. Starts dropped nearly 44% compared to March 2023, signifying a sharp slowdown in new multifamily development. So, echoes of booms and whispers of caution. The decline follows a period of robust multifamily construction activity in 2023. The current slowdown suggests a potential correction in the market as developers might be taking a more cautious approach due to rising interest rates and concerns of oversupply. So, what does this mean for you? Investors focus on new development. Be prepared for potentially for a more competitive landscape. And investors targeting existing properties, the slowdown might suggest and might present opportunities to acquire well-maintained properties at an attractive price. So, what do we have here? This article basically is saying that multifamily construction has slowed down. It is down 44%, almost half from the year before. So in March 2023, it is down significantly. It's down almost 50% from March 2023 new construction. And I think this is a leading indicator of where the multifamily market is headed. So I remember when I first got into real estate, I was wholesaling houses, and a real estate investor, I was like, how did you know? He'd been in the market for a long time. And I was like, how did you know about, did you make it through 08 okay? He was like, yeah, I made it through 08 okay. And I was like, how did you make it through 08 okay? He was like, well, I paid attention to new construction, new builds. And when new builds stopped or slowed down, that's when I decided to step out of the market or make sure I set myself up for long-term holds and then ride the wave out. And then once everything kind of settled down, hop back in the market. And so going back to what he said, this is a leading indicator. So you have leading indicators and you have lagging indicators. Leading indicators tell you something that's about to happen. Lagging indicators tell you something that has happened. And so construction starts tell you something that's about to happen. So this is a leading indicator of where, I believe that this is a leading indicator of where the multifamily market is going. It's definitely due for a slowdown. It's definitely due for a correction. And if in most cases, we're already seeing it right now in the market. We're seeing where sellers want more money than the property is worth. Buyers want to buy the property for far less than what the sellers are asking for. People have bridge loans where they have to rework the loans or rework the valuations. Borrowers are concerned about high interest rates. So all of that is going on in the marketplace now, but being that the new constructions are slowing down, new starts, new builds are slowing down, that is a leading indicator that we're going to have a correction in the multifamily space. It may be significant, it may not be significant, who knows? But there will be some type of correction, some form of correction in the space if it's not already happening now. So I think that's a good article. There will be some correction. Will I be right? Will I be wrong? We will see. Let me know what you think in the comments. And as always, make sure if you want to see any of these articles, go and subscribe to the Aparti newsletter. That's aparti.co/news. All right, let's move over to our third and final article of the day. Oh, yeah, this is a good article. Everybody has been talking about this in the space. So the article reads, Blackstone doubles down on multifamily. It acquires AIR communities for $10 billion. Now this is big. So the article reads, following the recent purchase of Apartment Income REIT, AIR, a private equity giant, Blackstone has struck again. This time it's acquiring multifamily owner and operator of AIR communities for $10 billion. Let's unpack the details and what it signifies for the market. So Blackstone continues its multifamily expansion. Blackstone continues its multifamily expansion. Blackstone's acquisition of AR Communities further strengthens its position as a major player in the multifamily market. This strategic move highlights the continued confidence of institutional investors in the long-term prospects of the sector. So, what does AR Communities bring to the table? AR Communities brings a well-represented name in the industry, known for its portfolio of well-located suburban apartments. This acquisition expands Blackstone's geographic reach and adds a significant volume of high-quality rental units to its holdings. Consolidation is on the horizon. This deal, coupled with Blackstone's previous acquisition, points towards a potential trend of consolidation in the multifamily market. Larger players with substantial resources might become more dominant forces. So what does this mean for you? It means increased competition, potential investment opportunities, and the multifamily market should see some type of growth in the long run. So what do I have on this article? Basically, this article is like it gives us a little bit of hope compared to the last article that we just read. So the last article said construction starts in low. I said that there's going to be some form of correction. Then Blackstone bets big on the large multifamily market by doing a $10 billion transaction. So this gives us some hope that multifamily is still a strong and resilient asset class. However, that doesn't mean that it's not going to be affected. That doesn't mean that we're not going to have a slowdown. In fact, Blackstone betting on multifamily and acquiring AR Communities signifies just that. They wouldn't have bought AR Communities a couple years ago because everything was great. It was all to the moon. Everybody was on, a euphoric ride with all the prices and inflation going on. But now we're starting to see some things level out in the property market and in the stock market. So Blackstone seeing this as an opportunity. I believe that Blackstone seeing this as an opportunity to acquire a well-run company that, with or without them buying the company, it was going to be here for years to come. I believe they've seen it as a strategic opportunity to purchase and gobble up more multifamily market share while everybody is still trying to figure out, are we going to crash? Is the Fed going to do rates? All of this. One thing for sure is that multifamily is going to be here for the next 10 years. Blackstone seen this as an opportunity to purchase a company and ride the wave into the future and ride the multifamily wave into the future. Now, what does this mean for you as a multifamily investor? If you are I say that this is the time period where you either double down on multifamily or you get out of the industry. And I say, as a multifamily investor now, as a multifamily sponsor now, if you choose to stick with the industry, pivot where you need to pivot, make some corrections to your business, and stick with it long term, you will be the next generation of titans in the multifamily space. Now, if you choose to take yourself out of the industry, go and explore other options, that's on you. But you can use this time to hone on your skills, learn how to do bigger and better deals, learn where you need to pivot, learn where you need to generate some more cash flow so that way you can ride the storm. And once you ride the wave, once you figure out how the industry is going to shift, use it to your advantage. Start buying more deals, stay within the industry. And I guarantee, well, I can't make a guarantee. I don't guarantee a lot of things, but I guarantee if you stick with this industry and you double down on what you already know is going to happen, you'll be in a better position and you won't kick yourself for not taking advantage of what's about to come. So that is all I have for today. Make sure you like, subscribe, and share the show. This is the first edition of the Aparti Daily Podcast. If you liked it, let me know in the comments. I'll keep doing it. If you don't like it, I'm still going to keep doing it. And then we're just going to figure out how to make it better over time. And as always, if you want to see any of the articles that we read today, go to apartify.co/news. Get on the newsletter. It's delivered straight to your inbox every single day, and it's completely free. So with that being said, I'll see you guys on the next episode.